Sol just remains consolidating inside it. So if this is distribution, the point of this, if this is actually distribution, then you see a mark down, which would mean a significant move lower into some area where it can reaccumulate. It won't just go down like that and then back up. That wouldn't be a distribution. That would actually be basically a very rare type of highly volatile accumulation, which isn't impossible, but is unlikely. And maybe we go back down and revisit some of these areas here if it does mark down. Otherwise, if it just stays inside here, all it has to do is get above the 172, and you'd look at that as being quite possibly reaccumulation. Bulls have won the battle, and we go up. But we'll see. With Bitcoin being where Bitcoin is, which is having pushed back up into its previous value area and rejected, you would say, a little bit of a cause for slight caution there. Now, holding in this area, as you can see, 58 was where we held previously. It's provided good support over here. When we would dip below 60, we wouldn't go below 58. We had a quick sweep below. But now you can see that the consolidations are happening lower, right? So it's consolidating here lower than it was there. And each of these pushes is pushing the market lower as well. So a lot of work has to be done for this to reclaim and remain bullish. But if you're looking at stocks, this seems much more like just a squeeze. It seems to be pretty relentless and slow, where it's just pushing and pushing and pushing up into its previous inefficiency level. So you'd want to see this flipping, let's say the daily bands, which is pushing into, because this rally up, when you go straight down, it leaves a gap where you can go straight back up. But if you go straight up, it also leaves a gap for going back down. These wide gappy moves, again, are not a sign of balanced markets. What you'd much prefer to see would be something like this, where you have this move up, you have a pullback, and you form a proper higher low. It tries to go lower, and then it doesn't. That would be a good sign. That would be a sign that we actually did retest all this. There is demand there. It rises up. If it keeps just pushing, that leaves a gap behind where it can just fall down into and not be, a bullish type of move. You can see these strong squeezes like this can be bearish in their own sense. So watching for that over the next days, possibly weeks. And then there's a lot of talk about liquidity. You've got the Fed's reverse repo. So this is some sources and areas where liquidity can flow back into the markets. There's still about, the RRP was down at 291. It's down about 300 billion. This can theoretically go all the way to zero. And if this goes down, it's adding liquidity to the markets. You can see this throughout 2023, went from 2 trillion, 2.3 trillion, all the way down to basically 300. So 2 trillion was added, 2.3 down to 300. So since the middle of 2023, 2 trillion has flowed out of that, and that has boosted asset prices like stocks and crypto. There's obviously not much more for it to draw down. Drawing down by 2 trillion has the biggest effect. The last 300 billion is clearly not going to have anywhere near as big of an effect. Then you have the Treasury, which is trying to rug me there. And this is the... Right, why is it buggy, is it? Interesting. Why can't we see Treasury statement? There we go. There we go. It is at about 800 billion. And that can draw down as well. And that will draw down towards the end of the year. Which would be a potential adding of, upwards of 800 billion of liquidity. So those are a couple of sources of liquidity that the market's looking at that should, in theory, be supportive of prices. But the market looking ahead needs to know where the next, big wave of liquidity is going to come from. That's money already in the system, but you're looking for, especially on Bitcoin, you're looking at when is the next big signal that they're going to print more, whether that's outright QE, or they call it something else. And there is no sign of that yet. Technically, the Fed are still doing quantitative tightening, where they're actually reducing their balance sheet. You want to see some indication from them that that's changing. First step for that would be the lowering of interest rates. But that isn't directly printing money. But it's a sign that we're starting to move in that direction. So we'll see. We'll see. The Trump an Elon Twitter interview basically didn't lead anywhere. Nothing, at least nothing for crypto. And to be honest, I read a couple threads about like the key highlights and stuff. Doesn't seem like there was really anything that interesting. It's just the usual talking points: immigration and inflation's so bad, and Joe Biden's low IQ, and it's just, I mean, it was pretty uninspiring stuff compared to what it could have been. Doesn't seem like there was any big bombshells, and I'm guessing it didn't really affect Trump's odds. No, still behind in the betting markets, and went from 45 ticking up to 46, so basically no movement. So, you know, at least immediately that hasn't had any change, and that makes sense because Trump said nothing. Like, he said nothing new. He just repeated the same shit, and Elon Musk didn't add anything really to it. Trump being back on Twitter should be a boost. He'll get more visibility than being on Truth Social, which obviously nobody has Truth Social unless they're already a right wing, and so you're not going to convert people. They're already going to vote Trump. Twitter, you might see some. And what else? That's about it, really. So then we move on to today, and I will cover this more on Trade of the Day. But today's big one is one of the inflation prints, which is PPI, which you need to go here. That is at 12:30 UTC, as always. That's the producer price index. So that's looking at the production side of the economy. And then CPI, consumer price index, is the other side. Consumers, obviously. CPI is what we pay for stuff. PPI is what producers who are making stuff are paying for their materials and output. So obviously CPI is more important in terms of the market. But PPI, definitely, especially if there's a big miss, either to the upside or downside, will have some impact. That will probably be the thing that will offer a trade, if there is going to be a trade. And I don't think, if I see a move today, probably is a move to the downside, if anything. But we might just get nothing in the end up. Mentioned this yesterday with this kind of red squiggle. We try to push higher, it comes back down. Roughly, we're in that kind of area, but you know, it's nothing that is really of major impact. If I just clear all this off and we look at the moves we were having on the way up, so you had swing highs, you know, price moving up, setting a swing level, moving higher, setting a swing level, coming back to it, teasing at a break of that structure, but really staying right at it, just not quite breaking the old swing low, moved up, moved higher, consolidated here before that breakout. There's a level there, and then of course price has started to step downwards. So it set a consolidation, moved below it, and moving below. So in between, it's not major bearish. It's just filled in this previous inefficiency from last Thursday. It's clearly not bullish, as you can see. You know, if you look at like a 4-hour trend, that has been lost. It's went from green to red, and if it's unable to reclaim that, if it does reclaim that and gets back above 60, that opens up these stops and hitting these highs. Otherwise, it's just pretty standard. Should go lower as the bands go red and we trend back down until it finds some kind of a low. And if you're looking at then where to actually target on that, looking at some of these areas where previous pumps happened, where people would follow and chase in, you've got untested areas there. This would be the main one, this 55.3. The untested area from this breakout has already been hit, so you can see it over here. We hit a pump on Thursday, price came all the way back, retested that. So that area has been retested. To the upside, there's not much that hasn't been retested yet. We pushed back up and filled in most of this gap. Little bits above here, you could say it. But most of the inefficiencies and the areas where there will be people out of position will be down here. When you have these one directional pumps, price hasn't retested 51.5 or 55.3. Those would be the ones you're looking at on the way back down. Above, of course, there's loads. We had a very inefficient move down in terms of lots of areas that haven't been retested, as high as 70 and 66 and 64, and loads of room for that on the way up, if and when the market builds itself into a uptrending structure again. But for now, I mean, it's sideways, and if the previous trend that we're in is down, which it is, and you're moving sideways after topping, then you would expect, if anything, it goes lower. But there's no clear impulse in the market yet. So higher probability of going down, but also the market staying above that 58, which is important. So for now, you're kind of stuck in two areas. You've got the 58.3 pivot, which has been going on for years and years and years, and has provided a pretty solid SR level, which we're currently holding. So it's the market trapped in between two phases. So that's when you get the choppiest markets. That's when you get the mean reversions. That's when the pumps fail. That's when the dumps fail. And best to wait for some kind of clear directional sign before we see the next trade. Some of the war trades have been picking up. So looking at crude oil. So if oil's rising, it's a sign of inflation. If people see oil prices rise, they're expecting inflation, because oil is the backbone of everything in the economy. And higher oil prices will lead to higher fuel prices, higher production prices for anything that's made out of petroleum or oil, which is fucking everything, plastics, bottles, everything. And, fucking flights, trucks, it's all oil. The reason it's rising, probably, is because of the tensions in the Middle East and the expectation that there might be more escalation of a war. And it's rallying, but it's rallying within a consolidation that it's been in all of this year. So this is the volume profile for 2024. And it's moving towards the value area high, but it's still in that value area. It is above the value area high of 2023, looking at this, which is interesting, right? That would indicate that oil is building higher and potentially going for a move towards 90. It wouldn't actually be anything of note until you did get above 90. That's when the trend higher would really affect things. It could come all the way up to here and just reject off resistance. So you have to wait and see with that. But it's definitely moving in a direction where people think about it, as is gold. Gold moving up for potential all-time high breakout, as is defense stocks like Lockheed Martin, which had a big pump last week and is moving up again. I'm very much of the belief, though, that this becomes a nothing burger, especially with something like Lockheed Martin. I mean, it did the same thing. This is when Russia invaded Ukraine, and everyone's like, holy shit, like Lockheed Martin's going to go up forever. And what did it do? It went all the way back and filled in the entire pump. And unless there's a major escalation of war, you're probably looking at something similar, where eventually it actually does just come back down. But that could sustain. We could go higher and higher. That could create more fears. Defense stocks, along with gold, along with oil, all of those rallying, would typically be a risk-off signal for the markets. That's, the assumption. And you can see clearly that Bitcoin is not following them. Like, Bitcoin is not the hedge against war, at least right now. Mostly because Bitcoin just has so many different participants, right? Some people will think that Bitcoin's a good thing to hold if there's going to be geopolitical conflict and war. But a lot of people don't. A lot of people think, no, I want to own Bitcoin whenever there's money printing. I want to own Bitcoin whenever there's risk-on activity in the stock market, et cetera, et cetera, et cetera. So even though I think 10 years from now, Bitcoin will be an undoubted risk-off asset as well, as people realize what it truly is, digital gold, store of value, all that, it doesn't mean it will be right now. It's still in that kind of adoption growth phase. So it's going to act more aligned with risk assets too. So we'll see how that goes if this continues. That's probably the other thing to keep an eye on. That's it. GM. See you later. Live stream 4 p.m. UTC. GM.